Hey there, future real estate moguls. Welcome back to the channel. So, you're thinking about investing in rental properties? Maybe you're looking for that sweet passive income, or maybe you just want to flex your financial muscles. Either way, you're in the right place. But let me guess, you've heard about rental property investments, but you're wondering, how do I actually know if a property is worth buying? Well, today, we're diving into how to analyze rental properties, break down all the numbers, and figure out which ones are the real deal and which ones are better off as Pinterest inspiration. So grab your favorite beverage, because we're going to break down the basics of property analysis. And by the end of this video, you'll be analyzing properties like a seasoned pro. And don't forget, if you like what you hear, hit that like button, subscribe, and share with someone who's thinking about getting into real estate. Trust me, you'll want to share this gem. Okay, let's start with the why. Why should you care about analyzing rental properties? Well, the truth is, buying a rental property isn't just about picking a place with a for rent sign out front and hoping for the best. If you don't properly analyze the property, you could end up with a headache, or worse, a money pit. I mean, who wants a property that eats up your cash flow instead of providing it? Not exactly the dream scenario. So you need to make sure the property you're eyeing will give you a solid return on investment, ROI. And trust me, there are a ton of factors that play into that. We're talking about everything from market trends to cash flow and the property's overall condition. Alright, let's talk about the core metrics you need to be familiar with when analyzing rental properties. These are the numbers that will help you decide if a property is a good deal or not. Let's start with the big one, the purchase price. This is pretty obvious, right? You need to know how much the property is going to cost you up front. The lower the purchase price, the better your potential ROI. But of course, there's a balancing act between price and value, which we'll get into in just a minute. Next up, rent income. This is how much you'll charge tenants each month. The goal is to have rent income that comfortably covers your expenses and still puts money in your pocket. After all, you don't want to be working for the rental property. You want the rental property to be working for you. Let's face it, being the landlord is supposed to feel like a side hustle, not a second job. Now, we need to account for operating expenses. These include everything that keeps the property running, from property management fees to maintenance, taxes, insurance, and utilities, if you're paying for them. That leaky faucet might be small, but trust me, the expenses can add up faster than you can say fixer-upper. This leads us to net operating income, or NOI. To find this, you simply subtract your operating expenses from the rent income. The higher your NOI, the better your property is performing. It's like a scorecard for your property's financial health. Think of it as your property's GPA, only instead of getting a scholarship, you're getting more cash in your pocket. Next up, we have the cap rate, which is a critical metric for investors. You calculate this by dividing your NOI by the property's purchase price. The cap rate helps you understand how quickly you'll get a return on your investment. So, for example, if you're buying a $200,000 property with an NOI of $20,000, you've got a cap rate of 10%. The higher the cap rate, the better the return. Think of it as the property's speedometer. It shows you how fast your money could be working for you. Now that we've got the basic numbers down, let's talk about something just as important. Location, location, location. Yeah, I know you've heard it a million times, but there's a reason that saying exists. The right location can make or break your rental property investment. Before you even think about buying, you need to research the local market. Is the area growing? Are people moving in or moving out? You'll want to invest in areas with a strong rental market and steady job growth. High demand equals higher rent prices and a better chance to fill your property quickly. Next, look at the neighborhood itself. Are there schools, shopping centers, parks? Is it a safe area? People want to live where they feel comfortable, so make sure you're investing in a location with good amenities and solid long-term prospects. And no, your rental property shouldn't be the one on the block with the beware of dog sign. You want it to be in a place people actually want to live. Alright, now we're moving on to the fun stuff. Property condition. This is where you need to have a sharp eye. Because while a low purchase price can seem like a deal, it can also mean a lot of repair work down the line. Always get a property inspection before pulling the trigger. You need to know what you're walking into. Is the roof about to cave in? Are the pipes about to burst? These are the things that can make your deal go from a great investment to a nightmare real quick. Trust me, you don't want to end up on a first-name basis with your plumber after you've signed the dotted line. If the property needs some TLC, make sure you factor in those renovation costs. Can you handle it? Is it worth the investment to fix up? Some cosmetic work is fine, but major structural issues could eat up your profits before you even start. Let's talk about cash flow and ROI, the two things that will keep you up at night, or better yet help you sleep soundly knowing your property is making money. Cash flow is the lifeblood of rental property investing. Ideally, you want positive cash flow, meaning your rent income is higher than your expenses. This creates a steady stream of passive income. If you're breaking even or, heaven forbid, losing money, it's time to reassess. Finally, let's talk ROI. ROI is a calculation of how much profit you'll make compared to what you invested in the property. The higher your ROI, the better. And remember, cash flow is great, but when you sell the property down the line, you want to make a profit too. You're in this to build wealth, not just pay bills. So make sure the numbers align with your goals. So there you have it, your ultimate guide to analyzing rental properties. From understanding the basic metrics like cap rate and NOI to evaluating the market and the condition of the property, you now have the tools to make smarter investment decisions. If you enjoyed this video and feel more confident about diving into the rental property market, give us a thumbs up, hit that subscribe button, and share this with anyone who's thinking about becoming a landlord. You might just be the one to help them avoid a potential disaster and land their dream property. Remember, a little knowledge goes a long way in real estate, and with the right tools, you can turn your investment into a cash-generating machine. Thanks for watching, and I'll see you in the next video. Happy investing, everyone.